Hello there. Welcome to the Open here on BNN Bloomberg. Let's get to the big stories we're bringing you from our newsroom. TD Bank posted profit in its latest quarter that topped estimates. Revenue jumped 18% year over year. TD saw record revenue in Canada. It was boosted by a rise in loans and deposits and strength in wealth management and the market segment. The quarter was also boosted by a decline in the provision for credit losses and higher banking revenue in the U.S. And CIBC's first quarter earnings came in higher than expected, with the bank reporting profit of nearly $1 billion, higher than the same period last year, topping estimates. CIBC posted better than expected results in capital markets, and it saw record revenue across all of its units, as well as a higher return on equity. This marks the second straight year that CIBC has beaten expectations, and the broader banking sector continues to see strong growth across multiple segments. Bloomberg says that the data center provider Equinix and the Canada Pension Plan Investment Board are nearing a deal to acquire North Holding for $4 billion US. According to the report, talks are at an advanced stage and the transaction may be announced as soon as this week. North is an Iceland-based company that operates data centers across Iceland, Denmark, Sweden, and Finland. A U.S. future set for a marginally higher open, including the NASDAQ. Now, Nvidia beat, its revenue jumped more than 70% in the latest quarter, but the forecast didn't thrill investors. Let's have a look at the TSX, our benchmark index closed at a record high yesterday. And let's check out gold to see how it's trading this morning. The TSX has been boosted once again over the past few weeks by higher gold prices, although they are slipping a little bit this morning. And let's have a look at the Canadian dollar. Canadian dollar holding, it's down a little bit, but it is holding above 73 cents US. And finally, Bitcoin. Let's see if there's any joy there. Nope, not for the Bitcoin bulls. Down almost 2% right now. So investors somewhat muted in their reaction to Nvidia. Of course, it had another blockbuster quarter. The stock, as of today, up almost 50% in the past year. Revenue soaring more than 70%. But the forecast not thrilling investors. Let's get perspective on the tech mega caps in general and AI from Christine Tan, portfolio manager at SLGI Asset Management. Christine, great to see you, and thanks very much indeed for joining us.
Good morning, Andy. Good to be here.
Maybe we could have a quick look at Nvidia and the pre-market. We didn't see a huge reaction to the numbers. Did anything jump out for you?
No, I think you summarized it really well. The numbers are very, very strong. And Jensen actually spoke about visibility into about $700 billion of spending related to AI CapEx this year, which is very strong. I think it really is about high hurdle of expectations. NVIDIA's done really well over the last 3+ years. So at this level, it's not as expensive perhaps as it was a year ago, but I think there's just a bit of this view from investors. And this is one of our key investment themes this year. It's just kind of looking out beyond the few core AI names to think about what the next beneficiaries are. But more importantly, who's being disrupted. Mm-hmm. There's also a little bit more caution around what we call CapEx fatigue. So on the one hand, $700 billion in AI CapEx is good for NVIDIA. On the other hand, what you're seeing is typically free cash flowing tech companies are starting to issue debt in order to fund these multi-decade type of investments. So there is a bit more kind of nuance in how investors are viewing a space where a year, 2 years ago, these kind of numbers would have been shared.
How are you guys playing the Mag 7 stocks now? Broadly speaking, are you overweight, underweight?
So our managers, especially the ones in the US, are there. They're quite selective on which companies within the AI space to own. One thing that they've been watching very closely is just valuations. So definitely not sort of overweight the complex, but there are a couple of names that they like from a relative risk reward basis where they would have a larger position, and there are a couple of names where they might not have a position at all because of valuations or perhaps some concerns around the visibility of how long these earnings can continue to grow at.
Broadly speaking, what is your equity allocation? I know your portfolios differ, the investor objectives differ, but are you overweight U.S. stocks right now, Christine?
We are neutral to our strategic weight. What we've been talking about since the start of 2025 is to really look for opportunities globally. So we're not saying that we're trimming U.S. exposure, but really allocating the incremental dollar to global equities. And it's a combination of global markets sort of having been a bit more slow in seeing the earnings recovery coming out of the lockdown and the reopen of the global economy. And also valuations are much more attractive globally. So that's been how we've been positioning the portfolio, neutral on U.S. But within the U.S., what's interesting is that year to date, the performance has been quite muted. But just like that duck on the surface of the water, there's been a lot of rotation underneath the surface of the market. So really kind of thinking more carefully about diversifying and broadening out the exposure in a more nuanced way versus maybe 2 years ago, where it was a much more concentrated market and also a much more concentrated global allocation to U.S. equities.
Broadly speaking, U.S. stocks you guys think are not that cheap. So even when earnings beats come in, we don't see a huge upside reaction.
That's right. That's right. So we're about 93% way through the S&P 500's earnings season. So call it pretty much done. And it's been a pretty strong quarter. 74% beat their earnings expectations. So in aggregate, earnings are coming in about 7.5% higher than what consensus was going into the season. So by all means, that's a very strong report card. But again, as you highlighted, and we've been talking about, just valuations are quite elevated, and so expectations are quite high. So the hurdle for the market to continue to reprice upwards is now higher. But again, if you look at the underlying dispersion, though, in terms of sectors, which sectors are driving the earnings beats, you're seeing more industrials, a little bit of contribution from consumers, although even within consumers and industrials, there's a lot of dispersion in terms of which specific companies are doing well and which companies are perhaps facing a little bit more of a challenging outcome. And you can really see that in the consumer space. We know that statistics show us that the top end consumer is doing very well. Although you are seeing some switch down. So we've been hearing that comment from Walmart, for example, that they're benefiting a little bit from consumers switching down to more value-oriented, that maybe consumers that didn't used to shop at Walmart as much before, but very nuanced. That's the term that we've been using, being very specific in terms of exposure and not making big, broad calls in general. And we're seeing that come through in the earnings, that very specific outlook, depending on the business and where that company sits in the value chain.
What about the Canadian banks? We got 3 big beats, a pretty strong quarter overall for the Canadian banks. Yeah, are you overweight those right now?
So our Canadian managers they do like the banks, and they do have a slight overweight to the banks. Starting about a year and a bit ago, they were starting to see the provisioning cycle bottoming out, not quite improving yet. And of course, we're nearing the end. We're not quite there yet. We're about 3 quarters away, 4 quarters away, but we're nearing the end of the worst of the rate reset for mortgages. So what I mean by that is, if you think back to 2020, 2021, when mortgage rates were very low, anyone that had a 5-year mortgage back then, you're starting to reset it today at higher interest rates. But we're getting close to that end of the cycle now, where rates are normalizing, and that change from the reset will no longer be as great. So that is a benefit, a net benefit for consumers. That's also a net benefit for banks. And we are seeing more of a fiscal response from the Canadian government in terms of spending, in terms of investment, and that in aggregate is positive for economic activity. On the other side, the employment picture is still quite soft in Canada. So it really is a combination of not necessarily being very bullish on the banks, but it is that they've done a good job managing their balance sheet through this cycle, and that provisioning sort of moderating and really bottoming out.
Thank you very much, Christine. Christine Tan, Portfolio Manager at SLGI Asset Management. Coming up, Canada's AI Minister, Evan Solomon, says he was disappointed that OpenAI didn't have any concrete proposals when executives of the AI company came to Parliament Hill to answer questions about what postings they saw by the Tumbler Ridge, BC shooter. We'll be right back. Artificial Intelligence Minister Evan Solomon says federal officials express, quote, disappointment to representatives of OpenAI after a meeting in Ottawa about the company's failure to warn law enforcement about posts by the Tumbler Ridge, BC shooter. CTV's Judy Trin has the latest.
4 cabinet ministers responsible for artificial intelligence, justice, public safety, and Canadian culture met with these OpenAI officials in the wake of the Tumbler Ridge tragedy.
We're here and we're very grateful for the ministers for inviting us to be here.
The ministers wanted clarity on protocols for alerting police.
And we are disappointed that they did not provide any concrete proposals.
Shooter Jesse Van Rutselar's use of ChatGPT was flagged internally for abuse and enforcement months ago. Van Rutselar was banned from the platform, but wasn't deemed an imminent and credible risk. And RCMP weren't informed until after the mass shooting.
A course of failure occurred here.
We need to trust their behavior, not their reputation. The reality here is we need to see concrete measures that are going to be put forward.
The global leaders in clean technology, artificial intelligence, life sciences, and quantum computing.
The Prime Minister has been actively promoting AI investment to spur trade. Mark Carney is now signaling he wants safeguards.
Obviously, anything that anyone could have done to prevent that tragedy or future tragedies must be done.
The government is working on a bill to stop online harm, but it's been in progress for years.
I am very concerned about the government's capacity and willingness to address artificial intelligence policy writ large.
No details have been released about how the shooter misused the chatbot, but OpenAI says it is helping the Mounties with their investigation. The American tech officials have also been asked by the government to return to Ottawa with better answers.
Meanwhile, a plaintiff suing social media companies took the stand in LA yesterday, alleging the tech platforms harmed her mental health as a child, accusing them of purposely making their platforms addictive to children and teens. The social media giants denied the allegations, saying they have guardrails in place to protect young users. ABC has more in this report.
I stand here on behalf of my generation.
Dozens of parents, youth leaders, and online safety advocates demanding change when it comes to children and social media platforms.
These products were launched to us without guardrails, without education, without warning to any parents. They entered our homes quietly, catching families completely unprepared. We became the testing ground, and so did our children.
They spoke outside a Los Angeles courthouse where a landmark trial is unfolding that alleges major social media platforms were intentionally designed to be addictive for children and teens. Meta, Facebook and Instagram's parent company, and YouTube, which is owned by Google, both named as defendants and deny the allegations. They've argued other factors contribute to the mental health of young users and that they have added things like parental controls to protect them. TikTok and Snapchat were also named in the lawsuit, but settled without admitting wrongdoing.
We need safety by design. These platforms should not be every day trying to, make new safety precautions for kids. It's Band-Aid, as I said before, they don't work. We need comprehensive, safety design, and if that's forced through legislation, that's the way it should have to be.
The 20-year-old plaintiff, identified as KMG, she claims she started using social media at age 6, became addicted to the app's features, which led to depression, anxiety, and body image issues. During opening statements, lawyers for Meta and Google claiming her depression and mental health condition were the result of family dynamics, not social media addiction. Plaintiffs allege the companies Meta and Google knowingly built features that encouraged compulsive use among young users and led to long-term mental harm. Meta CEO Mark Zuckerberg testifying last week, defending Instagram's restrictions that ban users under 13, saying, "I always wish we could have gotten there sooner." And when pressed about an internal email appearing to show goals to boost the time spent on apps by 12%, Zuckerberg saying, "We changed that." Jacqueline Lee, ABC News, Los Angeles.
Up next, we're going to look at the oil market. There are reports that OPEC is considering raising output in April. Traders, however, remained focused on potential U.S. attacks on Iran. We'll have more next. The world is watching oil prices with reports that OPEC is actually considering raising output in April. However, the main focus is the potential U.S. attacks on Iran if Iran doesn't offer concessions on its nuclear program. We were joined by Rob Thunnell, Senior Portfolio Manager at Tortoise Capital.
If there is some concern about Iran and exports out of Iran, I think OPEC wants to could demonstrate that, look, it's there to provide some extra supply if it's needed, and so that would probably be the primary reason. But there's plenty of oil in the world. The global oil market is oversupplied right now, and so that's why we've kind of seen oil prices decline. The only reason why they've been up is, in my opinion, is because we've got a geopolitical risk premium that's now added into the oil price.
Got it. But I mean, if there was to be a supply disruption in the Strait of Hormuz with everything that's going on right now, do you believe the market is kind of sufficiently ready to absorb the loss of some of those barrels? And for how long would they be able to do that?
Yeah, no, that's a good question. We look at this pretty extensively all the time. And so the answer to your question is the Strait of Hormuz is very important. It's probably one of obviously one of the most important pieces of infrastructure in the world. So if there's a prolonged disruption, oil prices are going much higher. We don't think that that's going to happen. But could there be a temporary disruption, potentially, or damage to some infrastructure in the Strait of Hormuz? Possibly. From our perspective, oil prices probably could go up another $5 or $10 to reflect that escalating tension with Iran should it really continue.
I take your point that you don't feel like that's going to happen, but I'm just throwing hypotheticals at you for the moment, right? Like if there was actually to be a full-scale conflict between the U.S. and Iran, which is something a lot of eyes have been on for a few weeks now, who would be responsible for upholding OPEC production quotas? Would it be like Russia, Kazakhstan? Are there other countries as well? Who do you think would be responsible for that?
Yeah, Saudi Arabia probably would step in and could produce more. But once again, it needs to have access to the Strait of Hormuz, right? UAE could step in as well. But because you're right, if we have more than a temporary disruption, you're right, oil prices could go well above $100 in the short term. But I do think that there is still plenty of oil supply available, and that there would be additional supplies of oil that would be able to come to the market should we have a longer term disruption.
Would Russia contribute to that as well?
I'm not sure if Russia can produce much more. I'll be honest. The Russian investment in the oil fields has been limited, and a lot of the oil majors are not in Russia right now, and so I'm not sure that Russia would add a significant amount to the global oil supply.
Because that's an interesting story right now as well. Like Russia also trying to comply with its OPEC quota, but using a lot of its oil production to fund its war efforts in Ukraine as well. Like how is that country balancing those two efforts, I guess?
Yeah, I mean, I think Russia's been trying to produce as much as it can. With the other OPEC countries actually increasing, adding back to the supply, to the global oil supply. You saw oil prices fall last year. They rebounded a little bit this year, but they fell last year, and that's obviously hurt the government revenues in Russia. Even though they've had producing a fair amount of the supply, obviously it's price times quantity, and the price has been much lower than it has been historically.
Let's turn more towards the Americas and North America, because we saw a report today that the U.S. crude oil inventory saw their largest weekly increase in 3 years due to higher imports. How much of that is coming from Venezuela at this point?
Yeah, there's probably some coming in. Well, we know there's Venezuela coming in, Venezuelan crude coming in. I think the president has reported that even as late as last night. So yeah, we do know that there was probably some Venezuelan oil that's been on tankers that has made its way here to the U.S. Now that will be, we're not going to have a massive amount. We'll have some additional oil, but for Venezuela production to increase, it's going to take a substantial amount of capital investment on behalf of some of the large oil producers in the U.S., probably, and international oil producers, probably more along the lines of like Chevron and Exxon and ConocoPhillips, to see material increases in Venezuela oil production.
Just before I let you go, does Canada have anywhere to play here in terms of like increasing oil production and contributing at all?
Sure, Canada's still important. Absolutely still important. With low oil prices, demand for oil could continue to rise globally, and so the oil needed in the U.S. Consumer demand for gasoline prices are low. Driving demand could be pretty strong this year, and so I do think that Canadian oil, Venezuelan oil, all forms of oil is still relevant and to grow economies. And so yes, I do think that all forms of oil will be relevant for an extended period of time, because oil demand has gone up probably 40 out of the last 42 years. It will continue to go up, and we're going to continue to need sources of supply to keep this economic growth engine, both domestically and globally, going.
Let's have a look at U.S. futures as we count down to the opening bells. Muted reaction to Nvidia's numbers, the guidance not thrilling investors. It looks like we're going to get a pretty flat open for U.S. stocks today. Yesterday, they closed just below, as you can see, 7,6946. And right now, they're trading at 6,963, as you can see. Still slightly below 6,978, which was the record high close for the S&P 500 on January 27th. Couple of stocks of interest. Krispy Kreme has been working on a turnaround, and investors buying into that story. They say that their profit margins did improve in the fourth quarter. They did a better job of outsourcing logistics. Now, revenue did slip 3% to just over $392 million. And then AMD is opening its checkbook. It's paying $150 million for an outfit called Nutanix. And you can see that stock is up. Nutanix, based in San Jose, California, sells software that helps companies manage their information technology infrastructure, such as data centers. Okay, we got those opening bells next. There you have it, the opening bell action on Bay Street and Wall Street. At the NASDAQ, it's Elemental Royalty Corporation ringing the bell. At the NYSE, it's Lumen Technologies doing the honors. It's time for the first 15. Let's check in on the equity markets to see, is the TSX in record territory yet again? Not quite. It did close at a new high yesterday, down very marginally in early trading. S&P, as you can see, flat. Flat. And the NASDAQ composite down slightly. Pretty muted reaction to the Nvidia earnings and forecast. But of course, that stock, Nvidia, the world's most valuable company, has surged almost 50% in the past year as of this morning. So investors really don't have much to complain about. Let's have a look at some stocks of interest, and we'll hit those big banks. There is TD, and you can see it's up. Investors like the look of the latest quarter. All three of the big banks coming in with earnings beats, and TD trading right now in record territory. I believe so. Anyway, give me a second, because of course it's complicated by their money laundering woes in the United States. but certainly a multi-year high for TD. Sure enough, yep, they're in record territory. Let's have a look at how CIBC's numbers are being digested by the street. Oh, yeah, very little doubt that they're hitting a record today. Those Canadian banks, over time, they've been the reliable performers. I wonder, in retrospect, of course, retrospect is always infallible. One should have just put their money in Canadian banks and forgot about it. Let's have a look at Royal Bank, the giant of the sector. Oh, slipping slightly in early trading, down 2%, 233. The record for RBC was at the very start of the year, January 5th, it was 238. We'll have more analysis of the banks shortly. And let's have a look at Quebecor. Incredible growth in wireless here. And that stock higher. Desjardins says wireless success story continues. Their average revenue per user growth turning up for the first time in 11 quarters. So they've had difficulty, it seems, squeezing more money out of subscribers. But incredible additions, wireless net additions of almost 74,000. And that was ahead of BCE's 53,000, Rogers 39,000, and Telus 50,000. So this newcomer is adding more wireless subscribers than the incumbents, and BCE, of course, is the parent of BNN Bloomberg. Let's check out some movers south of the border. We are joined by Jeff Morgan, Deputy Team Leader for the Bloomberg News Equities team. Thank you very much for joining us. Give us the rundown on Nvidia, please, Jeff.
Yes, Nvidia is definitely one to watch today. This is quite a remarkable move here, partly because it's so small and the beat was so big. So in the pre-market session, this stock was only up about 1%. For a company that just grew its revenues by 73% over the last year into this quarter, a 1% move on a report like that is somewhat remarkable. We have a number of people on the street kind of trying to parse that and explain that. But needless to say, investors had very high expectations for this stock going into the earnings season and going into this quarter. On paper, looks like the company delivered. If you look at not only the first quarter forecast, the low end of the range is way ahead of expectations. The profit margins, the adjusted gross margins are in the 70% range, and the revenues just beat. This company got price target boosts from Truist, Citi, JP Morgan, and Morgan Stanley, and yet somehow the stock, look at that in the regular trading session, up less than 1%. So a lot of good news had already been baked into this. Hargreaves Lansdowne, which is a research firm, had a note out this morning saying that there continue to be questions that remain about the longer term and whether AI spending can sustain the growth that we're seeing in Nvidia over the next number of years. Certainly that growth is pretty remarkable for what we're seeing right now. As I mentioned, 73%. Normally you would expect a bigger move, and in fact with Nvidia we have seen bigger moves when it's posted results, but not this time.
And Trade Desk under pressure. Can you remind us what they do, Jeff, please?
Yeah, this is an advertising media company, and this is one of these companies that are kind of in the crosshairs of AI. This is the worst performing stock in the S&P 500 so far today. It was down 17% in the pre-market session. And what the concern is here is that you're seeing weaker results from this company, and a number of firms are pointing out, analyst firms are pointing out, this is even before we've seen the full effect of potentially AI coming to eat the lunch of this company. So they got a downgrade this morning at Loop Capital. It also got a downgrade from New Street Research. And Bloomberg Intelligence, which is our in-house research firm here, put out a note saying that this is something where you have the threat of AI diverting traffic away from its traditional revenue streams in that advertising media business. And again, New Street Research saying we haven't actually seen the full effect of that threat yet, but the results today, even without that effect, are negative, and the stock is getting pounded as a result.
Jeff, thank you very much indeed. Jeff Morgan of Bloomberg. Coming up, we're going to drill into those big bank earnings, and we'll try to find out why Royal Bank was down at the open. That's ahead. Investors are checking out the earnings from CIBC, Royal Bank and TD. CIBC and TD hitting record highs. We did see some selling in Royal Bank at the open. Mike Clare is the man to go to for analysis of the bank results. He's Senior VP and Senior Portfolio Manager at Brompton Funds. Mike, thank you very much for joining us. Talk to us about TD, if you would. What jumped out for you with these earnings?
Sure. TD, TD, we saw pretty strong results from TD along with the rest of the banks. I think like all 6 banks essentially beat bottom line earnings estimates this quarter. So a pretty strong quarter from TD. I think what stood out to us in particular, first of all, results from the capital markets unit have been very strong, over 20% ahead of consensus estimates and growing at 65% year over year. So they've done obviously a very good job integrating the Cowen acquisition from a few years ago. They've been generating strong trading and fee income in that business. Along with that, I think TD, what stands out as well is they've sort of gotten back to their bread and butter of the Canadian personal and commercial banking business, with that business reaccelerating to some extent and doing a good job there. And then, of course, they've been undergoing a restructuring both in the U.S. and broadly across expenses. That restructuring program on their expense side is now complete. So they've taken almost $900 million in upfront charges, including $200 million in the first quarter, the current quarter, and that's going to generate eventually annual cost savings of $775 million, of which we'll see $500 million this year. So lots of good things happening at TD.
Can we talk about Royal Bank? We did see a little weakness in the stock at the open, but let's check it out as we move deeper into the session. Is there something that might have given investors misgivings here?
Yeah, I think so. First of all, for Royal Bank, which we still think is the number one bank in Canada fundamentally, does trade at a premium valuation. So the bar is very high for them.
Okay.
They did have a very strong quarter, but I think if we could pick on one area of weakness is that their credit losses still remain somewhat elevated. So they've reported impaired credit losses at the high end of their guidance range for this year. Some of that coming from the capital market side, which tends to be lumpier, but then looking at different trends, leading indicators of future credit losses, I think some of those trends are a little bit softer than their peers. So looking at things like new impaired loans, we saw after several quarters of declining new impaired loans, we did see an uptick in the current quarter. And one of the things driving that uptick is residential mortgages, particularly in Ontario, where the Ontario economy, of course, has seen the impact of tariffs on auto workers and other manufacturing sector workers. So something that I think the market is one quarter doesn't make a trend. The market's going to look at that and see the beginnings of potentially some future credit losses. But the other thing to consider on the residential mortgage side is that having a loan go impaired doesn't necessarily mean you take a loss. This is a very, very strong credit portfolio with very low loan to value ratios on the portfolio. So it's not doesn't necessarily translate into losses, but it's something to watch to see if that trend continues in the coming quarters.
And how about CIBC? That stock hitting a record high today.
Yeah, CIBC, we think probably had the best quarter among the group here. Now that all 6 big banks have reported, their bottom line EPS growing at 25% year over year, 16% ahead of consensus estimates. And we really saw strong results across all of their business units, driven by a number of factors, including margin expansion. So net interest margins continue to grow from prior quarters. Capital markets business was well ahead of consensus, growing over 40% year over year. We saw pretty strong results from their U.S. commercial banking and wealth management segment on both volume growth and margin expansion. And notably, as well for CIBC, I think we've seen pretty strong performance in their strategy of targeting, the mass affluent customer here in Canada, which tends to be a higher profitable customer, lower credit losses, better returns. And we continue to see them grow their number of clients there with 6% year over year client growth in that business, 12% growth in client balances in that business. And so that's really, it's a strategy that the team's been working on for a number of years that continues, of course, with the new CEO in place now. And they're really doing a great job across the board.
Mike, thank you very much indeed. Mike,
thank you.
Mike Clare, Senior VP and Senior Portfolio Manager at Brompton Funds. Coming up, Nvidia's revenue up more than 70% in the latest quarter. But will it quell concerns over massive AI spending? We'll have more after the break. Investors are digesting the latest results from Nvidia, the world's most valuable company, certainly on a market cap basis. It was a blockbuster report, record profits, but investors can't seem to shake their anxiety over AI. Is the spending too much? Are we in a bubble? Let's bring in Gil Luria, head of tech research at D.A. Davidson. Gil, great to talk to you as ever. What jumped out for you with the Nvidia numbers, please?
Well, they were very good. The numbers are staggering. And most importantly, they gave us more visibility than usual. They told us that every quarter is going to be up sequentially this year. They usually only give 1 quarter of guidance. They talked about how the orders are already well into next year. So the result was very good. Investors were anticipating that, however. Microsoft, Amazon, Google, Meta, and others have talked about increasing CapEx significantly, and they did so a month ago. So we knew this would be a good result. That's why NVIDIA has been the best performer in the mega cap group this year. And today is just a reflection of the market digesting that, not that the result was not good.
So the data center build out is the crucial driver for NVIDIA?
By far. Their other businesses have become really insignificant, gaming, auto, industrial, et cetera. Those used to be meaningful businesses as a percentage. They are no longer so, just because the data center business is many times bigger than it was just 3 years ago. So it really is about how quickly are we deploying data centers, mostly those big companies that I mentioned. How quickly are they signing up more customers to build those data centers for? How quickly can those companies build data centers? NVIDIA is no longer the bottleneck. It used to be the bottleneck. Now they're making the chips so efficiently that the bottlenecks are more around construction and HVAC and finding electricians and memory and other types of components that go into the data center. As soon as anybody has a data center available, NVIDIA can supply them the GPUs.
That's interesting. So there isn't the shortage that was plaguing some developers a while ago?
Yeah, the bottlenecks now are around advanced packaging, optical components, memory, which is why you can see memory stocks have performed so well over the last few months, is that those are now in rare supply, which is a factor for those companies building out these data centers. But again, it's just a matter of it's physically hard to build these massive buildings and install everything that needs to be installed. But that's still happening at a massive rate, right? Those companies I mentioned are going to spend over $600 billion building data centers this year, and most likely spend more next year. Investors will wait to get signs of that, though. Part of the reason that NVIDIA has been held back is that there's a sense that these numbers are so big that they couldn't possibly be higher next year. The dislocation there is that if you look at other stocks, like the memory stocks, like AMD, like Broadcom, the market is giving them credit for a peak of the cycle being 2-3 years out, where for NVIDIA, the stock price at 24, 25 times forward earnings is implying that this is peak cycle, that next year couldn't possibly be higher. So there's a little bit of disconnect, and hence the opportunity in NVIDIA.
Now, I'm looking at UBS here, and they say customer concentration increased in fiscal 2026, with the top 2 direct customers accounting for 36% of total revenue. Are they just Amazon and Alphabet?
And Microsoft and Meta. and Elon. Those really represent the vast majority of demand for Nvidia, and they have for the last 3 years. These are the companies that have the capital, that need data centers, and that have all the customers. So they're the ones that are going to be supplying the AI compute. Really, anybody else building data centers is building them on behalf of those companies anyway, whether directly or to provide capacity to OpenAI or Anthropic. So those are the customers, but those are also the companies that have the access to capital, both cash on the balance sheet as well as the cash flow to fund all of this.
I wonder, is that a vulnerability, though? Because say it's Alphabet and Nvidia. I mean, obviously, they are anxious to secure other sources of devices so that they can have competing suppliers.
That's right. So all these companies are uncomfortable that they're buying almost everything from Nvidia, and they're trying to find other suppliers. And really, the two options are AMD or to work with Broadcom to develop their own chips. They're all doing that. But apart from Google and their TPUs, all these other efforts are at very early stages. And part of the challenge is that you're buying an AMD chip or you're working with Broadcom on a chip, and at the same time, NVIDIA continues to leap forward on the technology and create such a big difference in performance that all these companies will continue to overwhelmingly rely on NVIDIA for their data centers because they want the best performance for their applications, for their customers' applications. And NVIDIA is not resting on its laurels. They continue to drive the technology forward and introduce new generations of chips and the products around the chips that are just much better than everybody else's.
Thank you very much, Gil. Really appreciate it. Gil Luria, Head of Tech Research at D.A. Davidson. Coming up, Paramount, the showbiz giant, posting mixed Q4 results as it continues its quest to acquire Warner Brothers. Okay, we just got numbers from Paramount, Skydance, and they're seen as mixed. The timing is significant, though. Paramount continues to compete with Netflix in the struggle to acquire Warner Brothers. Let's get more from Matthew Dolgan, Senior Equity Analyst at Morningstar. Matthew, great to see you, and thanks very much indeed. It seems to be a mix. Let's put up the stock in Paramount. I know to a large extent it's being driven by the competition to acquire Netflix, but what jumped out for you with these latest numbers from Paramount?
Well, the thing that jumped out most is that it is having some success with Paramount Plus and its streaming service, which is extraordinarily important because that's what the future of the business rides on. And I guess to step back a little bit, we think that the firm is on the right track. We like the start that the new management team is off to. And we're enthusiastic about Paramount at the valuation right here. Although, of course, as you said, Warner Brothers Discovery is the big wild card out there. And we'll see what happens with that, whether Paramount wins it, how much it has to pay if it does. And so things can change. But as the business stands right now, and if it doesn't get Warner, we like the track that Paramount is on. It's in a declining business, but it is moving in the right direction.
So their streaming business is doing okay against the big E, Netflix, for example?
Well, it is no Netflix, and that is one of Paramount's issues and why it is much more important for it, we think, to be able to acquire Warner Brothers Discovery to bring those two platforms together. However, while it's nowhere near Netflix right now, it is moving in the right direction. Revenue is growing really nicely. It continues to add subscribers. And although profitability took a little bit of a step back after being positive the last 2 quarters, it was still a drastic improvement over last year. The segment direct-to-consumer itself, which is mostly Paramount Plus, did reach profitability for the first time since Paramount Plus launched. And so really, we like where the streaming business is going, even though it is still small, and the future will be different whether it acquires Warner Brothers Discovery and therefore HBO Max to kind of merge with Paramount Plus or not.
And who is in the lead? Sorry, you touched on this, but who is in the lead to acquire Warner Brothers now? Who is the most likely buyer?
Yeah, that is a really tough call because we almost would say it's 50-50 between Netflix and Paramount. We think that Paramount has put out the better deal as things stand right now. We thought that was the case even before Paramount revised its offer this week, and then it sweetened it a little bit. So now it is offering $31 a share for Warner Brothers Discovery. It also has a so-called ticking fee, which means that starting on October 1st of this year, every single quarter that the deal hasn't closed, shareholders would get another 25 cents. And then it put in some other sweeteners to kind of ease the Warner board's concerns or some of the things they cited for why they preferred Netflix's offer. We've said many times these are not apples to apples deals, so it's not straightforward or objective which of the two competing offers is better. But Paramount did put in those other assurances and sweeteners. And so even more so, we think Paramount's offer is a little bit better right now. However, if the Warner board does indeed throw this back to Netflix and say you need to essentially make a little bit of a better offer, we don't think Paramount has raised it so much that Netflix would let that pass. And so to your question of which one is better or which one is more likely to acquire, we do think it's a toss-up. We think the Warner board probably ends up continuing to prefer Netflix, assuming Netflix is willing to even sweeten its offer a little bit. But then it's going to be up for the shareholders to decide and for them to approve if they do actually get to vote on that Netflix deal.
And there's been speculation, though, that Paramount would have to take on a pile of debt here to push this deal through. Would that tend to well, not cripple them, but would it clip their wings as they try to pay down the borrowing?
Well, the thing about Paramount is that it is not your typical company because it has the Ellison family money behind it. And so normally we would have thought that this type of deal would not be possible for a company in Paramount's financial position and of its size to undertake. But with that money behind it, and this is one of the things they kind of addressed as far as if debt's concerned, will that Ellison backing be there? And the answer is essentially yes. And so that kind of makes it not the same analysis as whether you're looking at it without that factor and the debt that they have. So to your question, normally it might be a concern for how they'd operate going forward. But in this case, we don't have too much concern that the money will be there for them to build and grow this business like they need to.
We'd better go. Thank you very much, Matthew. Really appreciate it.
Thanks for having me.
Matthew Dolgan, Senior Equity Analyst at Morningstar. Coming up, we're going to get more on the earnings from Canada's big six banks. The latest three were pretty significant beats, although investors not falling over themselves to buy Royal Bank right now. Stock down around 4%. Provisions for credit losses may be part of the story. Welcome to the second hour of The Open. Let's check out the big stories we're bringing you from our newsroom. Shares in CIBC jumping to a record high. First quarter results came in higher than expected. Profit topped estimates. The lender also posted better than expected results in its capital markets business. And there were record revenues across all of its units, as well as higher return on equity. The banking sector generally continuing to see strong growth across multiple segments. Shares in Gildan, activewear down about 5%. The apparel manufacturer posted sales and profit that beat estimates. However, the full year forecast missed expectations on both profit and revenue growth. Still, Gildan says North American demand for its products remains strong, with innerwear sales nearly tripling year over year. Stellantis shares, they've been struggling over the past year, but they are up 5% today. The automaker CEO says the company expects returns in North America to improve, with the sector being the biggest contributor to its 2026 profit growth. Those comments come after Stellantis reported a loss tied to its North American and European units. carmaker has scaled back its electric vehicle strategy after demand in Europe disappointed and the US removed incentives. There's a look at the TSX in record territory once again. Something of a juggernaut. Our market up 35%, excluding dividends, in the past year. Let me just have a quick look at the heavy value traders, the heavy duty traders right now. Suncor is slipping. Royal Bank, of course, helping to drag down the index. Celestica off about $10, but CIBC, as we just saw, up more than $4, and Shopify up $6. So those heavyweights are helping to keep the market in the green. And let's have a look now at the US markets. And they're fairly mixed. The Dow ahead slightly, but we are seeing weakness in the NASDAQ right now. Looking at the big traders in value terms, Nvidia is off about $7. Whoa, it's actually quite a drop for Nvidia. It's down almost 4% now. Tesla down about 1%. SanDisk is up almost 2%. And Broadcom, the chip giant, down around 4%. So quite a bit of weakness there in Nvidia right now. Let's get more on those Canadian profits in banking. RBC, TD, and CIBC topping estimates. We're joined now by Diana Avigdor, Portfolio Manager and Head of Trading at Barometer Capital. Diana, great to see you. Royal Bank down. We've heard that perhaps that was because of a rise in provisions. What's your take?
That's exactly it. It's also the more elevated valuation, but it's really the earnings were excellent across all of our banking sectors, plus minuses to everyone. But one of the things that really stands out for really most of them was the return on equity that they posted, great cost controls in the measurement of efficiency ratios. Bottom line regarding Canadian debt is that these banks have built up so much cushion. Capital ratios are very healthy. So they're going to be up and down. I mean, the banks in general are trading at pretty high valuations relative to history. I think it has various reasons, not just the earnings. There is a Buy Canada trade going on. TSX is, as you mentioned before, trading at an all-time high. There's lots to like here.
Yeah, the banks, they've just been so reliable. And it looks, a lot of mortgages still have to be renewed, but it looks like the market not that worried about possible defaults or home borrowers running into trouble.
Yeah, and, maybe this is what's bugging RBC a little bit, is that loan loss provisions were a little on the high end, and they originated from mortgages. All the other metrics like wealth management and capital markets, and like I said, they built up so much cushion, and just because some mortgages are a little off, it doesn't mean that they will not work out at the end. Now, we do need a macro lift to the Canadian economy in order for this to continue going. But we've been talking to you guys about this a lot. Oh, yeah. There really is a buy global trade going on, of which Canada is part of. And I think the marginal dollar comes into Canada before it comes into the U.S. And if I was to look at the earnings, Nvidia's earnings were great as well. Amazing, as a matter of fact. But it's trading down. I think the marginal dollar goes to the Canadian banks, the commodity trade, and the sell technology continues to be a theme. And you can see that today more than ever.
Let's put up a 1 year for the NASDAQ 100 as a proxy for tech stock. For one thing, we do hear that there's local opposition to data centers in the United States. and politicians will be forced to listen, presumably.
That's exactly it. The bear case is not that Nvidia is not an amazing company posting 75% growth in their all their metrics at 75% margins. The problem is the data center built out, and already communities from Virginia to Arizona blocking $98 billion in projects, citing electric bills, water issues. Nobody wants a data center in their backyard. So this might or might not be an issue. And then there is the debt that everybody that is bearish would like to talk about how the bad debts are piling up. We haven't seen any spreads blowing out or anything like that. It's all speculative at this point. But the bottom line is that it's just so much unknown. It's a new thing. We don't know exactly who's going to benefit. It's all speculation at this point, and we're not going to get resolution near term to our questions. It's 2, 3, 4 years ahead. So there's lots of volatility. And talking about volatility, the average stock in the S&P has had a move of 10%, while the index is trading at a high because they balance them out. But this kind of internal volatility has to come to some kind of resolution.
For the broad Canadian market, we've seen so many, I'm thinking more of the smaller and medium stocks, we've seen so many takeouts, privatizations, a sign that investors just will not pay up for Canadian equities, certainly if they're smaller. Is that trend going to reverse, Diana, do you think?
This is public versus private market conversation. And over the last decade, everywhere, there has been a decline in public markets. Exits from private equity into the public market have slowed. I think that what we've seen in the last 12 to 18 months is an increase in private exits into the public markets. We have in Canada, Apotex is coming to market. I think that if the equity markets are starting to pay up a little bit, then we will see some exits from private to public. But what we need is some kind of visibility into the macro, and we keep going back and forth. I think that what's going to be a relief for Canadian markets is when we start hearing about resolution to the CUSMA talks and see what happens to us here. And then I think that Bank of Canada will also be able to be perhaps more fluid in the rate environment, perhaps can take rates a little lower at that point. So I think they're holding back a little bit. Everybody's holding back a little bit to see what happens with the CUSMA conversations.
Diana, thank you very much indeed. Diana Avigdor, Portfolio Manager and Head of Trading at Barometer Capital. Quebecor beating analyst expectations in its latest results, and it's adding more wireless customers than the incumbent telecom giants. We'll be right back. We saw Quebecor going up at the open. Revenue and profit in the latest quarter beat expectations. Let's get more from David McFadgen, Managing Director of Institutional Equity Research at ATB Cormark Capital Markets. David, thanks very much indeed for joining us. I'm not sure, do we have David? There he is, in all his glory. David, thanks very much indeed for joining us. One thing that seems pretty impressive here with these Quebecor numbers is the company is adding more wireless subscribers, or did in the latest quarter, than the incumbent telecom giants.
No, that's true. It added about 74,000 mobile net adds. And if you look at the other three, the big three, BC, TELUS, and Rogers, they were all at around 40,000 in the quarter. And if you look at the previous quarters, Quebecor is continuing to gain more and more momentum on those three. So it's definitely taking share. I think it's having quite a good success in Ontario.
Is it, just remind us, how are they across the country now with their wireless offering?
No. So obviously in Quebec, the primary brand is Videotron. And then the primary brand outside of Quebec would be Freedom. And Freedom is primarily in Ontario, BC, and Alberta, and also in Manitoba now. Right.
And I mean, are investors comfortable that they can, that, for example, with the capex that's involved, the marketing expenses, that they can earn a decent return on this? Because they're up against some pretty powerful competitors.
They are, but look, if you look at the results, they're putting up impressive results. The capex has not increased at all. Well, I mean, it's increased modestly, but it's no big capex coming. But if you compare their wireless service revenue growth in the quarter is about 9%. The other three were flat in the quarter. The wireless net adds were quite a bit stronger. And then the one important metric that everybody looks at is wireless ARPU. That was up 1.4% in the quarter. So that's the first time in a long time where we've seen wireless ARPU grow for Quebecor. But if you look at the other three, they're all seeing declines in wireless ARPU. So it really is putting up much better results compared to the other three.
I'm looking at a 10-year chart, and Quebecor stock, I'm not sure if we could put that up, or even a 5-year chart. Quebecor stock, it's the 1 year, but on a longer-term chart, you can see Quebecor stock has gone pretty vertical.
Yeah, it's been my favorite telecom stock for many years, and it's definitely outperformed the other three by quite a bit, particularly over the last 2 years. And it's been raising its dividend, raised its dividend again today. The other three are not raising their dividend. And it has the lowest leverage by quite a margin as well. So it has the best balance sheet in the industry. And it's buying back stock. So, I mean, basically, when you look at it in all the metrics, it's definitely outperforming the other three.
And the yield now, according to Desjardins, something like 2.9% with this latest hike. It's a big hike in the dividend, 14%.
Yeah. And the payout ratio is still very low, the lowest in the industry by far.
And of course, before I forget, Quebecor competes with BCE, our parent company here at BNN Bloomberg. What could go wrong with this story? It looks like investors have been piling in, but there's always an iceberg out there.
Well, I mean, the growth for Quebecor is really contingent upon the wireless business. And so initially when Quebecor acquired Freedom, the big three were getting aggressive on price because they didn't want to cede market share. But they kind of gave up on that because, they didn't want to reprice their entire sub base, obviously. And they didn't like to see their ARPU decline. So the big three are really trying to get ARPU stability and maybe some growth. But in order to do that, they're going to have to continue to cede market share to Quebecor. Quebecor is a disruptor, right? And so typically the disruptor is the one you want to own.
That's interesting, isn't it? Before I forget, we are planning to speak to Pierre Pelado, the boss of the company, today on trading day. What would you ask him? What's a question he doesn't want to be asked? Is there something that investors are concerned about? Or I know I'm trying to, because the stock's done so well, I'm seeking any possible challenges here.
Well, I think the one thing people are worried about is could there be a big capex nut coming down the road? I don't see it, but that is one concern that people do raise because they have ambitions to continue to grow across Canada. They really need to upgrade their wireless network, say in Vancouver, British Columbia area or province, sorry. But they've been really focusing on Ontario, and they're really delivering on the results. And the pricing is very attractive because they're including roaming in all their plans. So you can basically travel the world now. You don't have to worry about roaming anymore. So that's very attractive for Canadians.
And can you remind me, do they piggyback on the systems, the wireless systems of the big players?
They do. So when you roam outside of the Freedom Network, you automatically transition now to BC's network. It used to be Rogers previously, but now it's BCE. But you wouldn't even know it. Like if you have a Freedom phone, you wouldn't even know that you're all of a sudden now on say BC's wireless network. And then they have roaming agreements with over 120 countries worldwide. So as you travel, you can just leave your phone on. Like you don't have to worry about it anymore, which is incredibly attractive for a lot of Canadians.
And just, sorry, we're almost out of time. Would you be a buyer of the stock with new money right now?
Yeah, absolutely. I mean, we have an outperform rating on the stock, but our target's 57. The stock's basically there.
Right.
So we're gonna be revisiting that tomorrow with our morning note.
Fascinating stuff. Thank you very much indeed. Really appreciate it. And just a reminder that at 1:20 p.m. Eastern Time today, we are expecting to talk to Pierre-Carl Bellido, CEO of Quebecor. Our guest there was David McFadgen, Managing Director in Institutional Equity Research at ATB Cormark Capital Markets. Coming up, we're going to highlight some Canadian ETFs. Stick with us. Time for the ETF report. We've been hitting on this theme, more and more actively managed ETFs, and we're going to highlight some funds in Canada. Capital Group Canada just launched a suite of active ETFs on the TSX. That was in October 2024. We are joined by Scott Davis, head of ETFs for Capital Group. Scott, thank you very much indeed. Can you just remind us, Capital Group, is it the same company, the California-based mutual fund giant?
Yes, Capital Group is the home to the American fund mutual funds, but also Capital Group ETFs and Capital Group SMAs, headquartered here in Los Angeles.
That's interesting. And of course, you, like other mutual fund providers, have adapted to the popularity of ETFs.
Certainly, yes. We've heard for many years the desire for investors to access our investment process in multiple vehicles, whether it's mutual funds, SMAs, or ETFs. And the phenomenon of actively managed ETFs is one that has been widely recognized by the market and is growing quickly.
So let's talk about a couple of the products here. You've got CAPI, Capital Group International Equity. What's the, I think we have a chart. What's the idea with this one?
Well, Capital Group International Equity, or CAPI, is one of our 4 ETFs in Canada, and it delivers an investment outcome designed to deliver a capital appreciation investing in developed and developing markets. And we see this as a really popular theme, particularly at the end of last year as investors were looking at their portfolios and finding that some of them have been overly concentrated in domestic equities or certain sectors. And as they were looking at that and looking to make changes, they were allocating to ETFs and actively managed ETFs. An interesting statistic we saw was that nearly 20 billion of ETF flows went into international ETFs last year in Canada. That was 2 times the cumulative flows into international ETFs in all of the past 3 years. So they're looking to diversify from some of that over concentration, and CAPI has helped them do it.
Okay, and it's done okay. I see a return of more than 30% since it was launched in late 2024. Talk to us about another one here, CAPM. What's the idea with this one?
Capital Group's multi-sector income ETF, or CAPM, is helping to deliver a diversified and durable income stream to investors. And this is really another theme that we see in Canada and in the U.S., of course, which is, baby boomers are now on average between 70 and 80 years old. They're looking to take distribution income in retirement. And in order to do so, they're looking at more than just the standard drivers of fixed income. And so a strategy like CAPM can look across the spectrum of fixed income sectors, investment grade, high yield corporates, securitized, and even emerging markets to deliver that high level of income. And that's what CAPM has been doing and is growing quite quickly.
Does it hold equities as well as just fixed income?
It does not hold equities. It's mainly focused on finding the most attractive fixed income sectors that deliver high income, as well as a total return.
I'm actually just curious, have you guys gone in for these covered call ETFs? As you know, they've been all the rage, pitched to people who are seeking income.
Capital Group doesn't offer covered call ETFs, but I think it plays on a larger theme, which is this desire for income and the desire for active management to help investors meet their long-term needs. So it's important for investors to make sure they understand what's inside of any ETF. For a long time, ETFs simply tracked indices, and most due diligence conversations were focused on how the index was constructed. But today, it's important that investors are going to kick the tires of the investment manager and understand the investment process, their use of derivatives, and exactly what type of fundamental research is being used to drive the investment outcomes. And that's where Capital Group is a differentiator with its global research network and fundamental research background.
Are you right now, though, are you marketing an actual Canadian equity ETF? And that's a pretty crowded field, I guess.
Right. Today we offer two equity ETFs in Canada, which is a global equity and an international equity. In our mutual fund range, we have a Canadian-focused mutual fund, and we offer a range of other services. And we're going to continue to expand and deliver on what we see investors needing in Canada. But across our suite of 25 U.S. ETFs, our 4 Canadian ETFs, we have a pretty comprehensive lineup of exposures for Canadian investors and U.S. investors.
And just tell us, how is the Canadian market different from the U.S. market? For example, I always think of the U.S. market as very complex because there would be these multiple classes for funds according to the sales structure. I know we had a bit of that in Canada, but it always seemed very elaborate in America.
There's certainly quite a bit of complexity in the U.S. I mean, the Canadian ETF market is a leader in the world. With $730 billion in ETF assets at the end of last year, over a third of that was in actively managed strategies, which is the highest percentage out of any of the markets around the world. So in a lot of cases, the U.S. is catching up on the actively managed ETF front because 11% is the growing percentage of assets in actively managed ETFs. And we're seeing that growing quite quickly. So we anticipate increased demand for actively managed strategies at the core of portfolios being used as building blocks to construct investor objectives and to meet those demands.
We'd better leave it there. Scott, thank you very much indeed.
Thank you, Andrew.
Scott Davis, head of ETFs at Capital Group. Coming up, we're going to bring you the latest headlines and update you on the markets. You can see stocks under a bit of pressure right now. Shares in CIBC jumping 3% to a new record high today. First quarter results topped expectations, profit was higher than estimated, and the lender posted better than expected results in its capital markets business. In fact, it was record revenue across all of the bank's units. See investors happy with that. And of course, the broader banking sector, according to the results we've had from lenders over the past week, continues to see strong growth across multiple segments. Royal Bank of Canada stock, we discussed this, slipping in early trading. However, the giant lender posted first quarter profit that beat estimates. Matthew Lee of Canaccord, the analyst, says the return on equity was impressive at 17.8%. The results were driven by gains in personal banking and wealth management. The stock, though, looks like a bit of a shadow over it, perhaps because of provisions for credit losses. They came in at almost $1.1 billion, slightly ahead of what the street was looking for. Shares in Canadian Utilities down about 3%. The company posted net income in its latest quarter that missed estimates, also missed on revenue. This is an energy and utilities firm. It says results were hampered by regulatory issues, as well as the wind down of a 2024 efficiency program. There was a write-down of assets in its Alberta portfolio after repeated power curtailments due to weaknesses in the province's electricity grid. And we're seeing a bit of selling in North America today, nothing drastic. A kind of a shrug in reaction to massive numbers from Nvidia. And chip stocks, Nvidia stock did drop. We saw it down more than 3%. And this has been weighing on other chip makers. Broadcom down as well in early trading. About the only tech stock that's seeing much buying right now, Snowflake, the software producer, up around 5% in early trading. Let's have a look at some of the losers in the United States. Jeff Morgan touched on this one. Trade Desk down. Profit was unchanged in the latest quarter. And there's Broadcom and Applied Materials, both chip stocks, and both losing more than 6%. Let's check out some gainers. Paramount Skydance seeing some buying right now. Of course, this stock largely driven by the battle with Netflix to take over Warner Brothers, but investors liking the latest numbers from the company, the profit topping the profit outlook, and Warner Brothers also. This was from yesterday. Said the Paramount offer may be better, and actually that pushed up Netflix because, of course, the company won't be committing to a big takeover. There is J.M. Smucker, and I'm laughing because my dad claimed that when he was a child and they had people over for tea, he would pretend that jam was an incredible novelty. And he would say, "Oh, jam," just to annoy his mother. Anyway, I don't know why that came into my head. Smucker upped, though. They have reached a deal with the activist investor Elliott on the board. Looks like the investor's happy with that. And Gartner, you can see that stock advancing 7%. Okay, let's have a quick look at winners and losers in Canada. And Enerflex seeing some buying right now. That stock's hitting a record high, actually, according to Bloomberg. This is a big provider of services to the energy industry. And it's been, it actually just cut back on some of its Asian operations, but investors love they like this divestment, it seems. And the outlook, the forecast from the company, seen as upbeat. Cargojet, that is the dominant Canadian player in air freight. And that stock, it's pretty flat over the past year, but rallying today up around 8%. And tariffs, though, have been hurting that company's business. But right now, though, the stock up. But let me just see. Yeah, it came under pressure, though, this week. Yesterday it dropped to only $92, and it was $98 at the end of last week. So it's something of a rebound right now for Cargojet. And Shopify, always volatile, up around 3% in early trading. And some of the losers in Toronto, Stella Jones, the maker of railroad ties, pressure-treated lumber, stuff like that. That stock down around 6%. Apparently, they are seeing weakness in their rail ties business, and fourth quarter profit missed expectations. And let's have a look at Gildan, the gigantic provider of T-shirts and innerwear. Is that the same as underwear? I'm not sure. Let's not go too deeply into that. They are setting lower than expected 2026 targets. And the Q4 numbers, Dow Jones calls the Q4 results sluggish. But of course, their sales jumped more than 30% after the acquisition of Hanesbrand. And finally, Celestica, it looks like it's down in sympathy with some of those big chip stocks. Coming up, hot picks, we are zeroing in on 3 small caps. On Hot Picks today, we're checking out three small caps. Our guest has Acadian Asset Management as his top selection. It's a quantitative investment manager. We're joined by Nathan Moser, Senior Portfolio Manager at Impacts Asset Management. Thanks very much indeed for joining us, Nathan. Before we get into your ideas here, I'm just looking at the Russell 2000 versus the S&P 500. And obviously over 5 years, the big cap index has been well ahead, but certainly not this year. The Russell is up about 7% this year, whereas the S&P 500 is pretty flat.
Yeah. Good morning. Thank you for having me. We are seeing a better start for small caps this year. It's been an even longer run than you suggested in terms of small cap underperformance, really going back more than a decade. And as a result, the asset class just got too cheap relative to large cap. and excuse me. And we expect that this reversion trade that you're seeing so far to start this year really has some legs to it.
Mm-hmm. And why is that? Just simply people, well, they've made a lot of money on these big US big cap techs in particular. I think people are worried about the capex being overdone in the sector.
Well, that's definitely a concern in markets. There's the chance that as capex gets pulled back, that you start to see some folks wonder about what's next. Really, the issue is you have extreme concentration in the largest companies in the S&P 500. Valuations and expectations have gotten to levels that we think are ripe for some reversion to the mean. And so that money, in our view, doesn't necessarily have to leave the market. We think it just moves down market cap. It moves to non-US regions. And so that's what we're seeing. Maybe one last point about why we're so positive on small caps. When we look at the relative valuation of small versus large, we're back to levels we haven't seen since the late 1990s. So we're effectively at 25-year lows. And so there's lots of runway for small caps to perform better going forward.
Let's get into your ideas here. Acadian Asset Management, a quantitative money manager, just won a huge mandate from a British player?
Yeah, that's correct. Acadian is a very well-respected quantitative manager, superior investment performance with respect to their strategies. As a result, we're seeing very strong inflows into Acadian. You referenced St. James Place. They just awarded a mandate to Acadian for nearly $17.5 billion US. That's about 10% of the assets under management. So very impressive growth. We think that continues in the future. And investors really aren't paying much for such a high quality business. It trades at about 10 times earnings. We think that's too cheap. And as you see in some of the news today in the asset management space, consolidation is a theme that is taking place. And we think the value of Acadian is materially higher, both on a standalone basis and if they were to pursue selling the entire firm.
What deal are you referring to, sorry, in asset management?
Yeah, so the proposed acquisition of Janus Henderson by Victory Capital.
Yeah.
And again, that's just a proposal. That's not a done deal.
Yeah, thanks for reminding me. Eastern Bank, also based in Boston. What attracts you to this name?
So we like the Boston region just in terms of its economy. Eastern has been around for in excess of 100 years, not that long as a public bank, but very strong community relationships, very strong deposit market share. We are really excited about the company's shift from being acquisitive. They had done several smaller bank deals to essentially saying no deals in the near term and really focusing on driving profitability and returning excess capital to shareholders. So the stock has started to perform better. We think there's more room to run. It trades at a high single-digit multiple of earnings. They do have an activist investor in there that is agitating for them to sell the bank. And while that's not necessarily in our base case, I think it represents the compelling value of Eastern Bank.
And then finally, is it SciBone? They're a medical device company focused on pain, joint fusion in part. So it's spine technology.
Yeah, so it's SI-BONE, a smaller, very innovative medical device company focused on the lower back, specifically the sacroiliac joints. That really has to do with lower back pain. And what they've done over the last several years has really been impressive. They broadened out the product lineup. They have strong reimbursement. They've been investing heavily in their distribution capabilities. And this is a circumstance where the fundamentals have improved materially, but the stock price has not. And so I think it's giving investors a chance where the market, and while I'm always one to respect the wisdom of the market's a bit short-term focused on this. I think they're missing the long-term value creation that the team at SI-BONE is creating. At Impacts, we're long-term investors. We're not going to focus on the market gyrations. We're going to focus on the destination. And the destination for SI-BONE is a much more valuable business than is represented today.
Nathan, we'd better leave it there. Thank you very much for joining us. It was great to hear about three names that were news to me. I wasn't familiar with those stocks at all. Nathan Moser, Senior Portfolio Manager at Impacts Asset Management. Up next, the Prime Minister is heading to Asia in hopes of strengthening commercial ties and opening new doors for Canadian businesses in the world's fastest growing economic region. We'll be right back. Prime Minister Mark Carney is headed on an overseas trade mission to the Indo-Pacific region. Meanwhile, the opposition leader, Pierre Poilievre, will speak to the Economic Club today, while Dominic LeBlanc, who's in charge of U.S.-Canada trade, he's the minister for that, among other things, speaks to the Canadian Club. Let's get more on these politicians and their movements from Jeremy Sharon of CTV. Jeremy, thanks for joining us. Just remind us, what is Mr. Carney's plan?
Yeah, Andy, look, this will be a busy trip for the Prime Minister, spending time in India, Australia, and Japan, starting in India, where trade will, of course, be front and center through all of these trips. When it comes to India specifically, Canada and India have already established that they will be working towards a comprehensive economic partnership agreement when it comes to trade, kind of a broader trade deal at some point. It is not expected that deal will be finalized during this trip, but the formal process will begin in terms of talks between the two countries. Defense, critical minerals, clean energy, all expected to be areas of focus during this trip across the board. And it is expected the Prime Minister will sign several agreements, including memorandums of understanding throughout some of these trips. Now, India, there's a lot of focus on this India trip, specifically due to the fact Canada has only recently started the process of resetting diplomatic relations with India. And yesterday, in a technical briefing with reporters going on this trip, a senior government official basically said that if the Canadian government felt as though that India was actively interfering in the Canadian democratic process, that the Prime Minister probably wouldn't be going on this trip. That is a downplaying of the situation, a significant departure from the stance of the Canadian government since, over the last several months. It was just in last June that CSIS identified India as one of the main threats for foreign interference and espionage. So it is expected that that will be a big focus during this trip, not just the trade aspect, but the security portion that the government seems to be, trying to downplay in the lead up to this trip.
Right. Of course, they were linked to a killing in this country. The India. Okay. The Conservative leader, Pierre Poilievre, speaking to the Economic Club this morning, focusing on trade and the economy. What's his message?
Yeah, a lot of people watching closely for this speech. Mr. Poilievre will, speak at length on a topic we have not heard him speak at length about yet. Canada-U.S. relations, almost infamously now, the Conservative Party shied away from much focus on Mr. Trump and Canada-U.S. relations during the last federal election, rather focusing on domestic issues. There is much anticipation as to what Mr. Poilievre could offer today during that speech, and if he offers any kind of new proposals in terms of where the Conservative Party stands on how to address the potential threats that Mr. Trump poses to the future of a free trade agreement between the two countries. So, many will be watching very closely, and there's a lot at stake for Mr. Poilievre on whether or not he chooses to bring forward something new during this talk. So, there will be a lot of people paying close attention to what he has to say today in Toronto.
Okay, thanks very much indeed. Yeah, apparently it'll be a vision for Canada-US relations. It will be interesting to see what tack he takes. Jeremy, great story. Thanks very much indeed. Jeremy Sharon, our colleague at CTV News. Yesterday on Market Call, we were joined by Darren Sissons, partner and portfolio manager at Campbell, Lee and Ross Investment Management. He covered global and tech stocks. His top ideas were Atlas Copco, automatic data processing, and CN Rail. Today on the show, it's Mike Philbrick, CEO of Resolve Asset Management, and he'll take your questions on ETFs. For drivers dodging around crumbling Canadian infrastructure, navigating our roads can feel like a winter sport. If you lose, it comes with costly consequences. CTV's Adrian Gabriel has more in this report.
Traversing roadways while dodging crumbling Canadian infrastructure can feel like a winter sport unto its own, with costly consequences. CAA reports its members in Ontario and Manitoba are forking over an average of $900 a pop out of pocket each time their vehicle is damaged by a pothole.
There's an additional cost that consumers bear or taxpayers bear when they suffer vehicle damage as a result of the infrastructure and the impact of our climate on the infrastructure.
It was on this side, and we went totally kaputso.
Georgia Nevinson's front tire was a casualty of a roadside crater.
Thankfully, my rim was fine. Otherwise, I would have had to fix those.
There's a real financial impact for Canadians.
There is. Do I now have to put in pothole insurance into my monthly budget?
Since January 1st, Toronto has repaired just over 23,000 potholes. By this time last year, the city had already filled 10,000 more. Year to date in 2024, road crews had patched up more than double this year's total. Toronto's Transportation Department says it's behind because crews have been too busy with snow removal operations. In Atlanta, Canada, Nova Scotia music legend Anne Murray recently took to social media, writing, "I'm going to get some sand for my car so I can start filling the potholes in the streets of Halifax." From burst water mains in Alberta to car-crushing craters, the cost of extreme winter weather is pushing rates even higher, according to the Insurance Bureau of Canada.
You need provincial governments, you need the federal government to really step up with funding for infrastructure that is more resilient to severe weather events.
This year in Toronto, they've nearly doubled the snowfall totals, and with more now falling, and with potholes that you can actually stand in, it's a safe bet that they will surpass last year's $153 million winter maintenance budget. Adrian Gabriel, CTV News, Toronto.
Okay, well, I'll be getting my bike out before too long, and there's a rule of nature here. Anytime you're not watching the road closely, you're going to be hitting a big pothole on the bike. Okay, we're just about out of time on the Open. Let's have, are we totally out of time? Oh, we got 1 minute. I hear that music. I thought I was going to get the hook. One stock we're watching is Dell Technologies. Maybe you can put up a 5-year chart. This is a maker of servers. There's a 1-year chart. Like many other tech stocks, it's come off its highs. Thanks, Control Room. They are expected to report after the market closes. It's interesting, the estimated PE for Dell, 12 times. So it doesn't sound astronomical, and you're picking up a yield of almost 2%. So there's another tech name, a play on the data center frenzy that will be providing results after the market closes. Thank you very much indeed for watching the Open. Morning Markets is up next.